In this video, I will show you the best Vanguard mutual funds to invest in, the foundational ones almost everyone should understand, plus a few extras you can layer on depending on what you're trying to do with your money. No BS, no 30 fund list, just the names that really matter, what they're for, what they cost, and how to actually pick between them. Now, quick disclaimer before I go any further. I'm not a financial advisor and nothing in this video is personalized financial advice. I'm just sharing the mutual funds I personally like and the ones a lot of investors have built their portfolios around and why. You should always do your own research and make decisions based on your own financial situation. Cool? Cool. Now, before we get to the lineup, let me explain why we're doing this on Vanguard specifically. Jack Bogle, Vanguard's founder, didn't just start a brokerage. He literally invented the index mutual fund. On top of that, Vanguard is owned by its own funds, which means it's owned by you, the investor. There's no outside shareholder demanding bigger profits. The whole company exists to keep your costs down. And that's why even decades later, Vanguard still has the cheapest, deepest lineup of mutual funds anywhere in the world. Now, one quick thing to know up front. Most of Vanguard's best mutual funds, the Admiral share class versions, have a $3,000 minimum initial investment. If you don't have $3,000 laying around yet, that's totally fine. You can just buy the ETF version of basically all of these for the price of a single share or even fractional shares in some cases. Same exposure, no minimum. But for this video, we're focused on the mutual funds themselves. Alright, let's get into it. Let me start with the most historically important fund Vanguard offers, VFIAX, the Vanguard 500 Index Fund Admiral Shares. This is the modern, low-cost share class of the very first index mutual fund ever created for everyday investors. The one Bogle launched in 1976. So when you buy VFIAX, you're not just buying an S&P 500 fund. You're buying a fund with a 50-year track record and the historical lineup that built the entire index investing industry. It tracks the 500 largest US companies, the giants that drive most of the market's returns. Expense ratio is just 0.04%, which means on $1,000 invested, you pay 40 cents a year. 40 cents. For a lot of long-term investors, especially anyone automating monthly contributions from their bank account, VFIAX is the absolute classic core holding. Next up is VTSAX, the Vanguard Total Stock Market Index Fund Admiral Shares. This is the broader, more complete cousin of VFIAX. Instead of holding the 500 biggest companies, VTSAX holds roughly the entire US stock market. Thousands of companies, large cap, mid cap, and the small cap, and all in one fund. Apple, Microsoft, Amazon, all the giants you'd expect, plus thousands of smaller and mid-sized companies you never heard of. Same 0.04% expense ratio and same $3,000 minimum. And honestly, a lot of people in the indexing community will tell you VTSAX is the single fund they'd own if they could only pick one for the rest of their life. So if you're choosing between VFIAX and VTSAX, the question isn't really which is better, because they perform almost identically. It's whether you want the famous S&P 500 specifically, or whether you want everything America has to offer. Either one is a fantastic core. Now, if you want income on top of growth, take a look at VHYAX, the Vanguard's High Dividend Yield Index Fund Admiral Shares. This is the mutual fund version of VYM if you heard me talk about that ETF before. Instead of chasing growth, VHYAX holds hundreds of established US companies that pay consistently above average dividends. Mature, profitable businesses that send actual cash back to shareholders every few months. The expense ratio is 0.08%, slightly higher than VFIAX and VTSAX, but still extremely low for the strategy. If your goal is to mix real cash flow into your portfolio alongside the growth pieces, especially as you get a little older, this is the mutual fund that does that job. Then there's VTIAX, the Vanguard's Total International Stock Index Fund Admiral Shares. Everything I've covered so far is 100% American. VTIAX is how you own the rest of the world in mutual fund form. One single fund gives you over 8,000 companies across both developed and emerging markets outside the US, names like Taiwan, Semiconductor, Samsung, Nestle, Toyota, ASML, and so on. Those are the international heavyweights you don't get exposure to anywhere else in your portfolio. The expense ratio is 0.09%, still incredibly cheap for what you're getting, with again a $3,000 minimum. Now I want to be honest about VTIAX because there's a real debate around it. International stocks have lagged US stocks for most of the last decade, and a lot of people skip it for that reason. But nobody actually knows which region of the world is going to lead the next decade, and US dominance isn't guaranteed forever. Adding VTIAX is basically insurance against betting everything on a single country. A common approach is to pair it with VTSAX, with VTIAX making up maybe 10 to 20% of your total stock holdings. It's completely optional, but it's the cleanest, simple way to truly diversify across the planet instead of just across America. The next one is VBTLX, the Vanguard Total Bond Market Index Fund Admiral Shares. Everything I've covered up to this point has been stocks. Stocks grow, but they also crash, sometimes hard. VBTLX is the calm part of your portfolio. It holds thousands of US investment-grade bonds, both government and corporate, all in one fund at 0.04% expense ratio. Same $3,000 minimum as the other ones. Bonds don't grow the way stocks do, and they're not supposed to. That's not their job. Their job is to be the calm part of your portfolio that holds steadier when the stock market drops and to throw off reliable income while they sit there doing their thing. When you're in your 20s and 30s, you might hold little or none of this, and that's totally fine. You got decades to ride out the volatility of stocks. But as you get older and closer to actually needing the money you spent years building, shifting a portion of your portfolio into VBTLX is one of the most common, well-established ways to dial down risk. If you ever heard the old rule about owning your age in bonds, VBTLX is the fund that rule is talking about. Now let me talk about Vanguard Target Retirement Funds. If you want the ultimate hands-off mutual fund, this is it. You pick the one with the year closest to when you plan to retire, say 2055, and the fund holds a complete mix of US stocks, international stocks, and bonds all in one single ticker. And here's the magic part. It automatically gets more conservative as you age, slowly shifting from stocks to bonds without you doing anything. Expense ratio is around 0.08%, one of the cheapest all-in-one solutions you will find anywhere. And the minimum is just $1,000, lower than the standard Admiral funds. One fund, fully diversified, automatically rebalanced for the rest of your investing life. For somebody who really just wants to set it and forget it, it is honestly hard to beat. Alright, so how do you actually pick between all of these? Here's my honest advice, and I want you to actually listen to this, because this is where most people overthink themselves out of ever starting. You don't need all of these funds. For the majority of people watching, just one of the broad ones, VTSAX or VFIAX, is geniusly a complete portfolio. Add VTIAX if you want global diversification, add VBTLX as you get older and want more stability, and VHYAX if you want a dividend tilt on top of the growth. And consider a target retirement fund if you want the easiest possible buy one fund and stop thinking about it option. The single biggest mistake beginners make is owning 8 different funds that all hold the same companies and then calling that diversification. It isn't. That's just clutter. Real diversification is picking a few funds where each one is doing a clearly different job. Foundation, growth, income, international, bonds. That's a real portfolio. Everything else is noise. And remember this, the best mutual fund in the world isn't the one that returned the most last year. It's the low-cost, broad, kind of boring one that you will actually hold for decades without panic selling the first time things get tough. That's how you actually build wealth. Not by picking the hottest thing on the moment, but by buying the right thing and then leaving it alone. If this video helped you out, share it with somebody who's stuck on the sidelines trying to figure out which Vanguard mutual fund to actually buy. And if you got any questions, drop them in the comments. I read every single one of them. See you in the next one.